I think we're going to actually have the projector work tonight, too. It'll be a nice treat, right? Okay. We've seen this a few times. Here it is. It's the accounting cycle. How far along are we in the accounting cycle at this point? All the way through 5, right? We've analyzed the transactions. We've posted them in the general journal, posted them in the general ledger, done the trial balance, made the worksheet out of it. We've prepared financial statements from the worksheet, correct? Okay, so tonight, once we've prepared the financial statements, we take the next step, and we're going to take the adjustments, and we're going to post them to the general journal and the general ledger, and then we're going to do closing. Okay? Closing, briefly, is we're going to take all of the temporary accounts. You guys remember permanent, temporary accounts? Take all the temporary accounts, we're going to zero them out, and we're going to close their balance out to... well, they're going to go to 0, but they're going to go where? Where's final resting place, owner's capital. Okay? We're going to do the actual steps involved in moving net income up to owner's capital, just like you do in the statement of owner's equity, or statement of owner's capital. Okay? Everybody looks excited about that, so let's move on. Go. Okay, we're going to add one new account at this point, and it's called the income summary, for those of you who have read the chapter. The income summary is a temporary parking place. We're going to take all of the revenue accounts and we're going to park their balance in the income summary account. Then we're going to take all of the expense accounts and park their balance in the income summary account. Then we're going to zero out income summary and move its balance to owner's capital. Okay? After that, all your temporary accounts have a zero balance. The technical features about the income summary account: when you start with it, its balance is always 0. When you're done, its balance is always 0. Okay? It's a very, very temporary account. Questions on that? Yes, ma'am?
Yeah, has that account always been there, or is that something that's new?
I've been hiding it from you. I'm just now breaking it out tonight.
I played in the, in the 80s. I don't recall ever seeing that.
I don't know what textbook you were using, but it's got to go somewhere, and we're going to walk through the mechanics of it.
Okay, so it's not something that, GAAP.
I didn't make it up. It's not specifically spelled out in GAAP.
Okay, so it's been there forever. I just missed it.
Yeah. Yeah. And there's a few others, and I'll pull those out from behind the curtain later. Okay? All right.
Yeah, you do accounting.
Okay, income summary, temporary account. It is technically part of owner's equity. Does it have a normal balance? No. If you have net income, it'll have a credit balance. If you have a net loss, it'll have a debit balance. Okay, so it could have either. Not to worry about it. Always starts with 0, ends with 0. If it's ever not 0 when you're done, something's wrong. But you won't ever have that problem. Okay. This is the meat and potatoes of tonight. When we're closing all of the temporary accounts, all the income statement accounts, there are 4 steps. All you got to do is remember the 4 steps. The rest of it's mechanical, and you can do it. All right, I know you can do it. First, take the revenue accounts. Revenue accounts have what kind of normal balance? Credit, right? All of you should be saying credit. There should be no hesitation here, right? Revenue has credit balance. We're going to take those and debit all those accounts to take the balance to 0 and credit income summary. Okay, for that same amount. Remember, for every debit there must be a credit. So this is how we're moving things around, by moving that extra debit or credit to the income summary account. So step 1, zero out the revenue accounts, move them to the income summary. Step 2, zero out the expense accounts, move them to the income summary. Expense accounts have what type of normal balance? Debit. How do we zero them out? You have to credit them, correct? Okay. Step 3. Take whatever the ending balance is in that income summary. Now that you've got all your debits and all your credits there, calculate the balance, move it to owner's capital. Good? Okay, there's a 4th step. Does anybody want to take a stab at it? Close the drawing account and move it to owner's capital. Exactly. Good? Everybody's got it? We can go home. Okay, here's the worksheet. We've all seen this. You did a few of them for homework. You're doing one for the mini project.
Can you go back a second?
Time's up.
Okay.
Are you good?
Yeah.
Okay. Remember, the slides are on Blackboard. You can get them. So we've broken down the worksheet. You've got cash through draw. This is your balance sheet. Everything fees income through depreciation expense is your income statement, right? So you can draw a line across here. Notice we've got our revenue and expenses in the income statement columns. Balance sheets in the balance sheet column. So these are your temporary accounts, your revenue and expenses, and we're going to zero those out. Good? So this account, we would have to do what to it to zero it out? Debit $35,000, right? And then we would credit income summary for $35,000. This we'd have to credit $7,000, credit $500, credit $1,000, credit $3,500, credit $367. Take that total and debit that to income summary. So the income summary, by definition at that point, has revenue minus expenses as its balance. Its balance is going to be net income. If you think about that for just a sec. Pretty straightforward, right? We want to move net income to owner's capital. So it's very logical. Good? Somebody nod yes or no. Okay. Or the proverbial I don't know. Okay. Okay, they're going to walk us through this in a little bit slower method. Notice we debit it, credit fees, credit income summary. Good? There's the visual. Here's the closing entry. This gets posted to the General Journal and the General Ledger later, so this slide's kind of out of order. Actually, I'm sorry, I'm thinking the wrong thing. Your adjustments get posted to the General Journal and the General Ledger later. Your closing entries get posted straight away, so I apologize for that. So where did it go as I skip slides? So you can write closing entries at the top.
It's a totally separate paper.
You know what? On the mini project, it's only about a half page of adjustments. So if you put the closing entries on the bottom half, I'm okay with that. Save a sheet of paper. Okay? But you can put closing entries at the top and go ahead and debit fees income, credit income summary. You're good to go. What's your posting reference going to be? Well, that's going to be you're going to post it to the General Ledger. So when you post it to the General Ledger, it's the account number for fees income and the account number for the income summary, correct? Okay. What?
That's a capital account, so it's like a 300 series?
309 on the
It doesn't tell me the account numbers, but yeah, I think it's 309 in the mini project. Okay? Okay, closing the expenses. You credit them to reduce them to zero, and you debit income summary. Blah, 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 blah. Here we go. Let's just show you the picture instead of all the words, right? So we've got utilities expense, salaries, supplies, rent, depreciation. We're going to credit each account for the full amount. Takes all the balances to zero, right? So then we would debit income summary for the total of all those. Good? You don't have to do this and, credit here, debit there. Credit here, debit there. You can do it all as one compound entry, right? We've talked about three-legged entries where you've got 2 debits and a credit, or 2 credits and a debit. Well, you now have 5 credits and 1 debit. Your journal entry's a little bit longer. It affects more accounts, but it's still in balance, right? All your debits equal credits. Yes, ma'am.
Can you answer my question?
Okay. Questions on that? Confusion? You're good? No? Okay. All right, so here you go. Notice the format. Date is the last day of the month. Debit to income summary. Debit the $12,367. Indent a little bit. Credit to salaries, utilities, supplies, rent, depreciation. List the amount for each account that you're going to credit. Again, it says closing entries at the top. You only have to write it once. You could have written it above the last one. You don't have to repeat it again. Everybody good? Okay. Posting reference, when you post it to the general ledger, is the account number. Good? So here's what your income summary looks like. In T-account format, we posted the credit, which was revenues, correct? And the debit, which was all of our expenses. The net balance is $22,633. Revenue minus expenses equals net income. And it just happens to, if I back up enough, maybe, just happens to equal the net income we calculated on our worksheet. So you've got a double check there that you can look at. Good? Okay. Okay. Moving on. Net income, I know that. Okay. Skip all the words. We take the balance from the income summary. Notice it's a credit balance because it's net income. We debit that and we post the corresponding credit to the capital account. When you credit capital, it goes up, right? So when you have net income, it increases the owner's capital. If you have a net loss, it would go down, right? So you can look at it and you've got that double check mentally to see, am I going in the right direction? Am I making the entry that gives me the desired outcome? Everybody good with this? Okay. Go. There you go. Questions on the general journal? No. Okay. Close the drawing account. Too many words. The owner had taken a $4,000 draw in this case. A draw is the contra account to capital. So capital increases on the credit side. When he takes a draw, it goes as a debit, right? Because it's a contra account. It reduces this balance. So to make that go away, we need to do what? Credit that. And we need to post the debit over here, which has the effect of reducing or lowering his capital account. Well, reducing or lowering, either one. They do the same direction. Good choice. And the entry for that. Debit to capital, credit to draw. Questions? Those are the 4 steps. They're really exciting. Yes? Okay. So when we're all done, after we post the credit to the drawing account, the debit to the capital account, drawing has a 0 balance, revenue has a 0 balance, expense accounts have a 0 balance, and your capital account has what? What? Well, it may have a negative balance. If you have a loss, it could. But your owner's capital account now has the same exact balance that you calculated on the statement of owner's capital. Remember the second financial statement that we've prepared. At the bottom, that double underlined number that we've prepared and calculated is 108,633. They will match at this point. So you've now made the general ledger match your financial statements. Okay? Everybody good with that concept? Okay. Go. Okay. So, a little quick summary. 4 steps. Close revenue. Close expenses. Zero out the income summary and move it to capital. Close the owner's draw account. 4 steps. Remember them, remember the order. The rest of it's mechanical, right? Really straightforward. Good? All fits on one piece of paper, nice and neat. Even on one screen on this computer it fits, which is an amazing thing. All right. So we've posted all those closing entries to the general journal so far, right? Now you go in and you post them to the general ledger. That's when you put in your posting reference to show that you posted them to the general ledger, correct? So the same posting reference rules apply as when you're posting anything from the general journal to the general ledger. Good? Let's see. Fees income. They're going to debit fees income, $35,000, zero it out, right? Posting reference came from where? We can't see it, but up here there's a 4 on the page for the general journal. It's off the top of the page. Good? You guys have done a lot of this, right? Good. Okay. On the credit side of that, post it to the closing entry, J4, credit balance to the income summary account, which is 309. You had it right. Questions? You guys are eating this up really quick. Are you confident? Comfortable? We'll do a few examples. Okay, so once we've done that step where we've created the closing entry and we've posted it to the general ledger, we have done steps 6 and 7. We're headed for step 8. Step 8's a lot of fun. Remember way back here at step 4 we prepared a trial balance? Right? We're going to prepare another trial balance. That's the easiest way to say this. This time, however, because all of our temporary accounts are 0, our trial balance is going to be a lot shorter, right? All you're going to have is your permanent accounts. The reason you do a post-closing trial balance is to prove that you're still in balance when you're done posting all the closing entries and the adjusting entries to the general ledger. It also is the place that you go the following month to get your opening balances to set up the general ledger for the following month, which is what you've done in the mini project, right? The first step is open the general ledger. We talked about that last week in the book on page 166 or 67. They gave you the post-closing trial balance from December, and they want you to set up January. So we went there and we pulled those balances. And remember, it was just cash, accounts receivable, equipment, accounts payable, and owner's capital, right? It was a very short list. There might have been a few more. But all of those debits and credits were in balance. So it proved that the prior month after we had closed, we were still in balance. Good? Exciting, I know. Here is an example of a post-closing trial balance. It's got, cash, accounts receivable, supplies, prepaid rent, equipment, the accumulated depreciation that goes with the equipment, treated as an asset even though it's got a credit balance, accounts payable, owner's capital, totals. Those are all your permanent accounts. Notice revenue's not there, expenses aren't there, draw's not there. Good? But we're still in balance, aren't we? So, pretty straightforward. If you can do the other trial balance, you can do this one.
Doing a post-closing trial balance in our mini practice.
You do, correct, you do one. It is the last step. And now you know what it is, so you can finish. Good? If it's not in balance, you got a problem, right? So you have to go back and figure out why you have a problem. Did you transcribe the balance from the general ledger account incorrectly to the post-closing trial balance? Did you do the math wrong when you posted the closing or adjusting entries? Did you not post something correctly from either the closing or adjusting entries? So you've got to go back and find it, because you've got to be in balance. If you're ever not in balance, you've got to stop, take a time out while you figure out where you're off, because you've got to fix it before you can move on. Okay? Who's excited about this? Okay, how many of the rest of you can raise your hand? Okay. That's still only about 40% participation. All right. Yes. Okay. The last step in the accounting cycle, interpret the financial data. The financial statements are, there's 3 of them. They are the official reports that we issue. Balance sheet, income statement, statement of owner's equity, right? There's a ton of information in there. There are tons of people out there who have no formal training, no accounting background whatsoever, and if you hand those statements to them, they're going to look at you and think you're from Mars, because they won't have a clue what it means. But you guys do. So a big part of your job is helping them understand what's going on. Excuse me. Every set of financial statements tells a story, though. I can just about pick up any set of financials you want to hand me and start with once upon a time, and we can walk through and tell a story. So, help me out here. Here's this JT's Consulting Services balance sheet at December 21, 2010. It's a couple years old, but we can still work with it. Tell me the story. What's the first thing the owner is going to want to know from this balance sheet? What? How much cash do I have? How much money do I have in the bank? How much does he have? It's right there. Okay? You're doing okay. You got some cash. You're still going to be in operations next week. It's good. What's the other thing he's going to want to know? How much money do I owe to others? How much is that? $7,000 accounts payable. So I'm going to have to pay somebody $7,000 out of this $83,500 that I've got up here, right? What else is he going to want to know?
How much people owe me?
How much do people owe me? Exactly. Accounts receivable, $5,000. I owe people $7,000, but somebody owes me $5,000. Not a good direction there, right? Oh well. I'm sitting on a lot of cash. I'm in good shape. And it's actually can be a good thing that people don't owe you money. It means you've collected the money. So that's a good thing. What else do you see here that the owner would want to know? What? Can you tell that from a balance sheet?
Oh, I'm sorry.
No, but we will get there. Save that one. What?
Profit.
Can you tell how much if he had a profit this month? No. Is he in general profitable? If he's been in business a while and he still has positive capital account, he's probably not losing money. Do I know that for a fact? No, but this is a good sign that his capital account is positive. And it's, fairly sizable. It's 6 figures. How old is my equipment?
Not old.
Not very old. It hasn't been around very long, right? So your equipment is pretty new. So maybe it's a new company, right? So there's things you can start to infer by looking at this. I've got some prepaid rent, so I don't have to worry about paying that next month. What? The rent, yep. So those are all good things. We covered this. We're going to skip this. Yeah. Okay. Income statement. What can we learn from the income statement? You're up. All right. So this month, here's our expenses, right? Income statement format lists revenue. Here's our list of expenses. These probably recur fairly similarly from month to month. What else can we tell from this? What's the big one? The first thing he wants to know. He doesn't want to know detail. What? Am I making money? Am I making money? Is he making money? Yes. How much did we bring in? 35,000. Okay. How much did I pay my employees? $7,000. There's all kinds of things you can ask here, especially if you have more than 5 expense accounts. There's a lot of detail and you can start to look at it. Okay? Good? Okay. Yes. And that is, what was that? Prepare financial statements, da-da-da. We did that. We did that. We're all the way over here, step 9. Not step 10, I misspoke. Okay. When you get out in the real world, this is just a little reminder. Most of the time, there's a piece of paper that crosses your desk that tells you to enter a transaction in the accounting system, right? So there's going to be an invoice from a vendor. There's an invoice where you bill a customer, and it's going to trigger some sort of activity where you go post it in the general journal, right? Okay, just think this through, because it's really what you're doing in the mini project, except you don't have these source documents, so I want to kind of highlight that. You have a list of what this activity was. It says, on the 3rd we went down and we bought this, or we collected money from customers, blah, blah, blah. But you're going to get a piece of paper. Each transaction's pretty much going to be a separate piece of paper. Post them to the general journal, which is what you've done in the mini project. Post the general journal to the general ledger. Create the trial balance, build the worksheet, do the adjustments, prepare your financial statements. Good? I really just wanted to highlight that you're going to get documents as opposed to just a great list of here's the transactions. Yes, ma'am?
As you get source documents, you get them daily or multiple ones each day or whatever.
Right.
You would document each one on a daily basis probably, or as you get them in the general journal and ledger, and then at the end of the month do the worksheet?
Yes.
Okay.
Yes. Because if you wait until the end, it's going to be a big project. Yeah. Unless it's a really, really small company. Yes.
I just wanted to make sure, you had mentioned, you had asked about the depreciation, about how old that was.
Yeah.
It's the same amount though every month that you're taking, the 367 that you had on the previous. You don't double it for the next month and then.
It would be 367. Let's back up a little bit. So we're making an assumption here. We don't know if this is one asset or several that adds up to be 367. We don't. Okay? But let's assume it's one. So the following month, it would be another 367. So your balance here would be 367 times 2. And this amount would go down. The third month, this would be 3 times that. It just keeps getting larger. Yes.
Okay.
So if we had a beginning balance of $1,000 and we posted 367 to it, it would be 1367, and this would be 20,633, and it would continue to balance out. Okay? Yes.
But your original equipment was at purchasing was 22.
And we never change that until we sell it or dispose of the asset.
Look at that number and then the number over to the right and see that it hasn't gone down very much.
Right.
Okay.
That's kind of what I'm basing it on. Are we making sort of an assumption? Yes, but we've got a pretty good guide here that that's really what's going on. Other questions? Okay. Dun, 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 dun. Go. Talked about that. That's it. That's the real meat and potatoes for Chapter 6. There's not a lot to it. It's really 4 steps. Remember the 4 steps. Zero out the revenue account, move it to the income summary. Zero out the expense accounts, move it to the income summary. Zero out the income summary, move it to owner's capital. Zero out the draw account, and move that to owner's capital. Good? Post it to the general journal, post it to the general ledger. Do the post-closing trial balance, you're done. Good?
So the revenue and expenses go to the same account, the income summary account?
Correct.
And then it goes to the capital.
The ending balance of income summary goes to the owner's capital account. Good? Okay. Questions on any of that? So,
You said on the mini package, we could do the closing entries here, but when you're doing it in real life, is that normally a completely another page in a general journal?
the adjusting entries get their own page typically, and the closing entries get their own page typically. But you're working with a small chart of accounts in the mini project, so they'll both fit on one page. If you want. If you don't, then don't worry about it. Okay?
Gotcha.
Other questions?
So we're adding the closing entries to the general ledger? Or are you making new ones?
Yes. Think about the concept here. When we start the closing process, we've done the worksheet, we've prepared the income statement, the statement of owner's equity, and the balance sheet. Have we at that point in the process posted the adjustments to the general journal or the general ledger? No. The only place they exist is on the worksheet. So if you were to take the balance in your general ledger, it does not match the financial statements that you just went and handed out to everybody. That's kind of a scary thing. So your goal is to make the general ledger match the financial statements that you just issued. So you've got to post those adjustments from the worksheet to the general ledger. General journal, general ledger. Good? Yes?
Why don't you just do it after you do the worksheet? Why do you wait? I mean,
Typically, the owner is sitting there, the 7th, 8th day of the month going, where's my financials? I want them. I want them. So you postpone that a little bit so that you can get him the financials sooner. Then you go back and you post the adjusting entries from the worksheet to the general ledger. Okay? So after you do that, then you do the closing entries on the general journal, general ledger. And once you've posted the closing entries to the general ledger, your general ledger balances match those financial statements that you just handed out, including the owner's equity on the balance sheet. Remember when we were preparing the statement of owner's equity before? We would start with beginning owner's equity, match the worksheet, and then we would calculate a completely different number that didn't match. Well, now they match. The general ledger matches that statement of owner's equity at that point. So you're good at that point, and you're ready to set up for a new month. And that's the objective. Good?
so the general journal, you do, after you do all your entries for general journal, then you enter you do the closing entries, right? That's the way that all should, or
So the worksheet is done, then that's your general ledger.
Okay. Worksheet. Then you post the adjusting to the general ledger, to the general journal and general ledger.
We can't see, sorry. We
Why not?
can't see because of the reflection.
Yeah, whatever you're writing.
Is that better?
Yes.
Okay. Let's see if this one's better. Adjusting goes to the general journal and the general ledger. Okay? Then you post the closing to the general journal and the general ledger. And then you prepare the post-closing trial balance. Good?
The financial statements are generated after the adjusting and...
The financial statements were prepared up here. Hang on. Here. Okay. So we've got a completed worksheet. We do the financial statements. Then we do the adjusting entries all the way through the general ledger. Then we do the closing entries all the way through the general ledger. Then we do a post-closing trial balance to prove that we're still in balance and everything's good. And we're done for the month. Okay? Other questions? What? You start all over. You do opening balances in the general ledger for the next month, and away you go. What was that?
The adjusting part of the worksheet, I thought it was,
The adjustments are on the worksheet.
they're on the worksheet, but they're after the financial?
Hang on. I shouldn't have written this up at the top. You analyze your transactions. You post to the general journal, post to the general ledger. When you're done, you post your trial balance, do the adjustments, which gives you a completed worksheet. Worksheet prepares the financials. Then you actually post the adjusting entries to the general ledger. After that, then you can go close all the temporary balances out and do a post-closing trial balance. So the accounting cycle that we've been showing on that chart is that. Yes, ma'am?
In your opinion, do smaller companies do go through this process every month?
You have to. Yeah. I mean, I've seen companies that only do this part of it, doing financials once a quarter. So you're doing this for 3 months and then you still do this, but you're still doing all of that at some point. Okay? And if you're using a computer, it does a lot of this stuff for you. You're still doing the adjustments, but it does all the other good stuff for you. So it saves a lot of time. Okay? Yes?
So the computer can't do the adjustments, it can't figure out depreciation and stuff?
Remember, adjustments are something there's no document for. Remember over here, these are all driven by a document, an invoice in or an invoice out. So you get to the end of the month, how do you know to expense part of the prepaid rent or the prepaid insurance or adjust supplies or calculate depreciation? Does the computer know what the ending supplies balance was? No. A lot of them will do the depreciation for you. It'll calculate that number and just keep doing it until it's gone, which is nice. But it won't know if you bought a new asset, so you're going to have to add that and set it up. But you're going to have to tell it ending supplies, make the adjustment for the rent, prepaid rent, and things like that. So there's no substitution for a good human brain. Yet. Okay? Next question. Okay. Go ahead and turn that off.